Alrighty, welcome on back to another Meet Kevin Report. It is episode 103. Pretty important week this week, mostly because we have so much stuff happening this week, which is actually quite exciting. I enjoy it when there's so many catalysts just in one week. I mean, just the fact that tomorrow we're going to have CPI, that is in 25 hours and 9 minutes, we'll have the CPI report. Then we'll have the Federal Reserve decision the very next day with PPI coming out. That'll be 5:30 a.m. for PPI, and then of course we'll have the Fed at 11 a.m. all times here Pacific, and then we'll see what happens with retail sales the next day. We'll see what the ECB does, the European Central Bank. We'll look at what we end up getting from. Whoopsies! I'm gonna knock everything over here. We'll end up getting some. We'll get a little bit of a look into what even the. Oh, come on, Mr. Camera here. We'll get a look into what the Bank of Japan ends up deciding as well, which is interesting because the Bank of Japan is really your last. There we go. Fix that gimbal there. Your last developed country to not hike. So we'll see what happens. Now, Japan obviously undergoing yield curve control and really trying to massage their bond market and their currency markets in such a way where they'll be able to preserve their attempts to stimulate without causing inflation. Although even in Japan in this last cycle has experienced some level of inflation, which for a lot of folks has been a surprise because Japan for a very, very long time has not experienced any inflation. I mean, this is why a lot of people refer to the 90s for Japan as just a period of like a lost decade where Japan was able to stimulate but not actually cause any kind of economic growth, which was pretty remarkable to some extent, but also disappointing. But it led to this consideration that, wait a minute, does or do you actually end up getting inflation from printing money? And at least in the case of Japan, the answer to that was regularly no. The What we figured out, though, of course, in just the last, what's this silliness here? There we go. What we've just figured out, though, in the last cycle here is that it's not really directly inflation that causes the or I should say money printing. It's not really directly money printing that causes the inflation that everybody is concerned about. It's actually the rapid acceleration of the pace of the money printing that causes the inflation that we've seen, which is pretty remarkable because it'll lead into some of the topics that we've got to talk about today. We're going to end up talking about the Federal Reserve, what some of the bears are saying, what Morgan Stanley's saying, and some other folks. So we've got some good entertainment to cover, especially a potential flip-flop from the Federal Reserve, which I'm excited to get into. Now, before we do, let's see here. Let's see if I can get this open. I was hoping to actually start a Twitter Spaces at the same time and kind of just have this Meet Kevin report going. But every time I open the Twitter app and I try to go to my little Spaces thing, it seems to be crashing on me. So I don't know if that's just an Android issue today or if that's a Twitter issue, but I don't think that's going to end up happening. So I'll just restart this thing. I am also not the most proficient in Android, so I will give it that. And also being sort of in a mobile setup, sometimes things are a little harder and more unfamiliar, but we will do our best. The good news is we've got everything moving pretty well here. So I think as long as I don't drop my screen again, everything should be okay. So continuing. So pretty entertaining week. Not only is that going to be entertaining, but there is this possibility of a shift from the Federal Reserve. Now this, I think, is actually quite remarkable. And that's what we're going to talk about next. Give me just one moment here. And if I can't get this to work, I will just delete that post and then we will forget about it. But we will try the Twitter one very more time. Hop into the app to start your space. Your fans are waiting. Yeah, no, I see. It would be nice to be able to. What's going on here, Elon? It'd be nice to be able to start the space. But the Twitter keeps stopping. Okay, whatever. I will just delete that. And we'll have to figure that out at a different time. If failure, delete. Tried. Okay, so with that said, let's get into the Fed topic. Sorry, Elon. I don't know what it is. My profile doesn't seem to be able to stream anything on Twitter. Okay, maybe on shadow banned. Ooh, I thought Elon, we weren't supposed to do that anymore. All right, let's talk about this Fed topic because it's actually a big deal. Okay, here we go. There's potentially another flip-flop happening at the Federal Reserve, and it has huge implications for you if you're in the stock market. Now, yesterday, I posted a video on a lake, and if you go back to that video and you listen to what I said 6 minutes in, you'll find something very important. I suggest that it's 6 minutes into the video, I suggest the Federal Reserve might let us know that they're going to be more impatient, or they're going to be more patient with inflation because they don't want to cause as much economic hardship to employment. In other words, they don't believe that they actually have to crush employment to get inflation down. Well, when I woke up this morning and I read this, I just about freaked out because here's an article in Bloomberg that literally reiterates the maybe I talked about yesterday, and I'm absolutely blown away. Listen to this. Fed backs away from wage focus, bolstering case for rate pause. And I'm like, you've got to be kidding me. The very next day. I'm not trying to pat myself on the back. I'm just trying to say, like, this is obvious. If the Fed stops trying to crush employment, then the Fed will not hike again. This is potentially highly incredible, and almost certainly then, if that is true, the end of the cycle. So listen to this. Federal Reserve officials are rethinking their view that wage gains are fueling inflation, a key intellectual shift, flip-flop, that bolsters the case for a pause in their tightening campaign. Now, this is important. They don't give this context, but there's something known as the Phillips curve, and it's basically to say that when inflation is, or sorry, when unemployment, the unemployment rate is low, so in other words, a lot of people are employed, well, inflation should be high. That's the idea of the Phillips curve. And the Phillips curve teaches you that if inflation is high, you must increase unemployment to lower inflation. That's the point of the Phillips curve, this ability to sort of jigger one up to get the other one down. That's the thesis. If you have too low of inflation, then you want to get to maximum employment. That is the principle behind the Federal Reserve and their rate hike thesis, one of them at least. And so the Phillips curve has been relatively broken for the last about 13 years. Because if you look at about 2013, well, so maybe last 10 years, 2013 to just past COVID, you've really found, and even till now, you've really found that unemployment could be very, very low without causing substantial inflation. And this has led to a lot of economists wondering, okay, so is the Phillips curve dead? Is it broken? Was it never actually accurate in the first place? And more recently, you're finding, well, it's probably going to be true again. We just needed an inflationary impetus to prove that it was true. But now economists, especially at the Federal Reserve, are scratching their head again, going, but what if the Phillips curve was never correct in the first place? What if we can actually have low unemployment and then high inflation for a period and then come back to low inflation? Now, this is pretty incredible because listen to how this continues. Until recently, many policymakers at the U.S. Central Bank maintained that the road to lower inflation ran through the job market. The idea was that because labor costs make up a substantial portion of the cost of providing services, an area where price pressures have especially been persistent, workers would need to feel some pain. And so this is another very common argument, especially when we talk about core inflation and services inflation. So your more super core inflation. With your more super core inflation, what you're actually saying is, hey, look, super core is really focused on services and stripping out a lot of the goods, the volatile parts like some of the auto sales, the housing sector, stripping out the energy inflation figures. We take all that out, and what we're left with are the things that we really spend money on that require labor, which are going to be things like haircuts, dentists, CPAs, medical care services, doctor services, attorney services, funeral services, right? These are all relatively labor intensive. And so what you find is if you have super low unemployment, there's this thesis that, okay, well, that's going to drive inflation up, right? Because people feel like they can just switch jobs and get higher pay. And that has been true for a very long period of time, especially since there have been so many available jobs. And the argument has been that's clearly what's driving inflation. But now economists are somewhat flip-flopping and they're suggesting no, maybe that's actually not the case. In fact, the article goes on to say new research and commentary from officials and economists, especially at the Fed, suggest the link between wages and prices may not be so direct. And it's arriving just as the Fed is nearing the end of its historic hiking cycle. If the link between wages and inflation isn't as strong as policymakers believe, then you do run the risk of softening the labor market without seeing much progress on inflation. Now, yesterday I suggested that we might end up having a Federal Reserve that says, look, we don't necessarily need to end up causing unemployment. And that is what I think is so incredible is this idea that if the Fed comes out to, in 2 days and says, we're okay keeping people employed and not throwing people out of their jobs, and at the same time we can be patient with getting inflation down, then we have a massive game changer ahead because markets are not pricing in the Fed being unwilling to let employment or unemployment rise. In other words, markets are pricing in that the Fed is going to cause unemployment. That's what markets are pricing in. And that is the basis of the bear thesis. Because the bears believe once we start causing unemployment, we're going to have an earnings recession. But wait a minute. If the Fed changes the script and says, wait, no, we don't actually need to cause unemployment. First of all, the bears are going to lose their SH9T because we're going to realize, oh my gosh, the whole narrative that we've been told, which is the Fed's going to cause unemployment, will end up being false. That's remarkable. And it's especially remarkable because of the following. So I was debating this bear, and then we'll keep going with this piece here. I was debating this bear just the other day, and it was, well, guess I shouldn't. Oops, that's the other thing. I guess I shouldn't necessarily call it a debate. I would call it more of me asking some pointed questions. We'll put it that way. And the reason I ask these pointed questions is because this person has a bearish tilt. I think they're very educated. I think they're very smart and they have very good arguments. But I do think they very clearly have a bearish tilt, and that's okay. So they make this argument here. Lots of comments about bears being dead lately. I think what people are forgetting is something broke in the system. The regional banking system, Fed forced to inject liquidity via the Bank Term Funding Facility, and markets bottomed since then and have been higher since the end of last year. Now, what's interesting is markets are higher because of the wealth effect, or driving the wealth effect higher rather, which you'd think would reignite another round of inflation. There have been slight cracks in the job markets and a sign that the economy is slowing, but people's assets are up, so people have more money to spend, and overall the job market has been relatively resilient. So basically, buried into this argument is this idea that, hey, look, you need to cause unemployment because the jobs market has been resilient and people's wealth is going too high, and that's going to cause inflation. Now, my personal counter to that, which is sort of more of a tangent to where I want to get to, my argument to that is obviously check out the coupon code linked down below because we have a big expiration coming up this Friday, which is after this crazy week. But this Friday we'll be having another coupon expiration, mostly because we're going through the starting phases of a new refresh of adding a ton of lectures. We're going to keep the old lectures, but we're adding a ton of new lectures to make sure people get a great start in all of the courses. So we've got some really cool updates coming for those. But really built into this argument here is the thought that if we don't cause wage loss or sort of job loss, then people's wealth will be too high and will cause inflation. The counter to this is, well, look at 2012 really to 2020. We didn't cause inflation solely because people's wealth went up, right? So there's not a direct link between, I would say, the stock market necessarily always driving people's spending up and causing inflation. The wealth effect has a larger effect on consumer spending when it comes to real estate prices. But even then, if our economy can absorb that additional spending, that is because supply is becoming more efficient or we're becoming more productive as workers, then we don't necessarily cause that inflation. So now what I think is interesting is actually, I'm not trying to pat myself on the back here, but I end up replying with, Hey, so to clarify, you're basically saying the wage effect is going to lead to higher spending, and therefore a higher propensity of businesses to raise prices, right? The response here is without demand being crushed, inflation will remain sticky and elevated. The wealth effect is driving assets higher, and that keeps the stickiness going. And so the stickiness argument is probably at this moment one of the most powerful arguments the bears have, which is that as long as inflation remains sticky, the Fed's going to have to act harder and raise rates more. Now, I dispute that because I believe the Federal Reserve does not actually have to raise rates more. I believe the Fed could actually say, "Look, we're happy with rates where they are, and what we'll do is we'll just wait for that stickiness to go away." Unfortunately, for really the bears, if the Fed just waits for that stickiness to go away, well, then what you end up with is a situation where patience prevails, and if patience prevails, that sticky inflation will probably trend away without crushing markets or employment. But my favorite response here was actually, where's my chart? I had a little chart that I replied with. Oh, maybe it wasn't actually in this reply. Oh, here it is. Okay. So I wrote, and services inflation is still sticky. That was sort of I was summarizing his argument, pre-summarizing his argument. And so then I asked him, I go, how much Fed patience do you think markets are pricing in right now? Because take a look at this chart. This chart here shows that US wage growth continues to soften. But what I really want you to pay attention to when we look at this chart, when we blow this chart up that I posted on Twitter, follow me on Twitter, by the way, at RealMeKevin. When you look at this chart closely, what you'll actually find is that it peaked right at the beginning of where that 2022 number starts, so January of 2022. Well, inflation didn't peak until 6 months later, which suggests that if there is a link between wage growth and inflation, what we'll actually end up seeing is a 6 month delay. And if you look at this chart, you can see we've had the largest declines most recently in wages, which somewhat suggests that if the largest declines in inflation have been recent or in wages have been recent, then the largest declines in inflation are yet to come. So this really coincides potentially with this flip from the Federal Reserve on, hey, you know what? We're going to be more patient. We're not going to force a job loss because why would we cause job loss if we don't have to? If we could just let the dynamics of basically inflation prove itself to end up being transitory by being patient. Now, don't get me wrong. When I say that, there are a lot of people who say, oh, but Kevin, they were wrong the last time. They were. That is correct. But that doesn't mean they have to be wrong twice in a row. Now, there's a chance of that, of course. We're jaded against the Fed at this point. Remember last time they were still printing money in March of 2022 when inflation was 6%. That was stupid. My 7-year-old knows you don't still print money when inflation is 6%. But that's what happened. Anyway, so looking forward, when you overlay, and this is an interesting chart as well, when you overlay what's actually happening with inflation and you overlay that with what's happening with wage growth, you could see this a little bit more clearly. So I'm going to throw this on screen here, and that would be, well, hopefully it actually ends up appearing. So I'm having a little bit of an issue getting it up at the moment. Hold on a sec. It's supposed to be there, but it's not. Okay, I will plug that in again. But basically, it just overlays inflation coming down with wage growth coming down. And the argument is that, okay, well, if both are slowly trending down, then maybe we don't need to raise rates more. This article continues and also suggests that the prospect of, oh, here it is. I finally got it to show up. Oh, how interesting. Its presentation mode is a little funky, but you know what? That could end up being okay. So we'll just go with it. I think we'll just go with it. Yeah, it's just showing the whole presentation mode, which is usually it's cleaner and just shows the picture, but whatever. So anyway, so here you have that U.S. wage growth, inflation slowly moderating, and we want this moderation to continue. Here on the white line, you'll see U.S. average hourly earnings right here, and we can see we've notched the lowest level here at the lowest advance of wage gains in the last 12 months. So we can see we're really seeing this moderation happening. Slowest advance in nearly 2 years, actually. Look at that. Nearly 2 years, you have the slowest advance in wages here. And then the blue line is inflation. And what you've seen is you've seen this decoupling, right? So you see this inflation right here, this blue line, and you see this wage growth actually falling and decoupling away from inflation. That's actually quite remarkable because, again, it's reiterating this idea of, wait a minute, maybe wages aren't what's actually driving inflation. Maybe this really is a was a supply chain issue. Anywho, so that's a pretty big chart. But then there's this idea that, okay, well, what about, the banking crisis, or how is this going to affect jobs in general? And this article goes on to say that initially, while we thought really cooling the labor market was important, this article points out that in just the last cycle, in the May meeting, Jerome Powell, in his press conference, said the following, quote, "I do not think that wages are the principal driver of inflation. I think wages and prices tend to move together, and it's very hard to say what's causing what." Powell's remarks alluded to a crucial question in the emerging wages versus prices debate. Are wages a large driver of inflation? Or is it more likely to be the other way around? Is inflation a driver of wages? And this is fascinating because it goes back to the argument of the wage price spiral. The thesis used to be that if wages go up, people will be able to spend more money. And because they can spend more money, businesses can end up demanding more money. And then wages go up again because businesses demand more money, hence there's more inflation. You end up getting employees going, well, dude, I can't survive. I need more pay. Maybe that argument is actually entirely flawed. Maybe what's more likely to be true is, hey, a lot of people have more money and they're buying our crap a lot more, and business is doing really well, and we actually have supply chain shortages leading to price increases, but that's leading to profits rising at businesses. Hey, how about letting the employees share in some of those wage gains? Employees get wage gains. Then the supply chain shortages go away and profits stop growing as wildly. And what happens? Oh, wow, maybe wage growth plummets. So maybe wages don't actually drive the prices businesses are setting. Maybe it's really just demand. Okay, interesting. So, anyway, new research from within the Fed system also supports this thesis. A statistical analysis suggests faster wage growth has contributed, quote, only minimally to faster inflation in recent years, according to a column by the San Francisco Fed. The columnist noted that businesses can absorb those costs via lower profit margin or using automation. This is when wages go up. Businesses can basically absorb those with more productivity or whatever, rather than solely continuing to raise wages. Before the pandemic, groups often referred to pay bumps as basically the start of inflation, but we've really not seen that. Inflation, let's see here. We also, this was a good chart as well. Then they go into this chart on small businesses and wage gains. There we go. I fixed the iPad in the meantime. Take a look at this. Fewer small businesses plan to boost pay. Share of companies actually raising wages remains elevated. So in other words, you have the blue line indicating net percentage of small businesses raising wages, that's the white line, and then the blue line is net percentage of businesses planning to raise wages in the next 3 months. So you have this differential of basically, hey, have you raised wages versus are you going to raise wages? Now, I'd really like to see Bloomberg or somebody do is I would like to see this chart for companies like Pepsi and Kimberly Clark and Procter and Gamble, and basically your consumer staples, where they keep bragging about having raised prices. But I actually think the chart here is very much the same, where you have a lot of businesses who have just raised prices or year over year have raised prices, but the number of businesses planning to raise wages going forward, or companies planning to raise prices going forward, is much lower than those who have. So I actually think this is quite a fascinating chart because it really shows you that difference. Additionally, they have some quotes in here about how there's this mismatch between mapping inflation and wages, and I think that really just goes to reiterate some of the things that we've just talked about. But I want to talk about some of the implications of what this Federal Reserve policy shift could mean, and specifically how we might identify it in the FOMC conference. So first of all, If the Federal Reserve suggests that, yes, indeed, we are willing to let the unemployment rate stay low because we don't believe that the unemployment rate causes inflation, then what the Fed is really doing is they are telling you, hey, everyone, we're not going to force a recession. In fact, we think that inflation can slowly go away without causing joblessness, and your stocks are going to go up. That, I think, is in the most clear English what this Fed flip-flop could mean. Now, I understand there are these traditional arguments. For example, somebody who takes this argument very clearly is actually somebody I met on a playground, which sounds very odd. But Chamath has this sort of traditionalist argument of we need to see the Federal Reserve absorb liquidity. We need to see the Federal Reserve continue with their quantitative tightening, and basically all of that money that was injected into the system needs to be sucked out, and that sucking out is going to drive markets lower. Chamath has been a big proponent of sort of not being in the market, not being exposed to a quantitative tightening regime because we don't know the outcome of quantitative tightening. And this is a very fair argument because technically he should be correct, but he might not be correct because when we look at the first sort of real drawdown of refilling the Treasury General account, for example, last week, we look at this first real liquidity drawdown. What ended up happening? Well, what ended up happening was, and again, I'm not trying to pat myself on the back. It was just a very clear prediction. What ended up happening was what we talked about. The reverse repo facility saw its balance go down, and we saw the Treasury General account go up. In other words, some of this quantitative tightening that everybody is afraid of is really being buffered by the repo facility. Now, so what is the repo facility? And explain it to me like I'm five. Basically, when banks have extra money bags sitting around, they can put those money bags at a special place. And we call that the repo facility. And the amount of money bags sitting there is roughly in the amount of $2 trillion, which is pretty remarkable because it's a lot of money. And we just saw reverse repos drop about, let's see here. I'm trying to pull up a chart of reverse repos if I can. But we just saw the reverse repo facility drop about $106 billion as the TGA, the Treasury General account, was being filled up. And it's not a surprise because you can actually make more money buying 6-month T-bills right now than you can make in the reverse repo facility. And so what's great about this is really another way of saying that the Federal Reserve can allow this tightening to occur. And all we're really doing is removing some of the buffer that banks have. We're not necessarily taking that away from people. This is phenomenal. So really, you're in this, I hate to say it, but potentially giddy, scary, Goldilocks environment where we don't cause massive unemployment. We therefore don't cause a recession, or if it is a recession, it's very nominal. Quantitative tightening doesn't actually hurt us because the reverse repo facility buffers us. Once the reverse repo facility draws down to zero, which will take a very long period of time, and we consider even if you're tightening to the tune of 100, which you're tightening to the tune of about $80 billion a month. But let's consider, along with Treasury borrowings, it's $100 billion a month. It would take you 20 months to draw down the whole repo facility. 20 months of drawdown is basically just over a year and a half. A year and a half from now, we'll be in 2025. The economy could be so beyond a recession that any of the actual impacts of tightening might not matter at all at that point. At that point, it's like, sure, go ahead and tighten. Don't worry, the party's still going. So again, I'm not trying to come across as like this perma bull. I really am trying to study the bears as much as possible, and I'm trying to understand what everything is happening in the economy. And it's very difficult to put it all together, but when you start putting the pieces of the puzzle together, you go, wow, if the Fed on Wednesday reiterates their shift away from causing unemployment First of all, that'll be very politically popular, and you're going to get a lot of people alleging that Janet Yellen and Joe Biden gave the, Mr. J. Powell a little phone call, and they're going to put their tinfoil hats on, and they're going to make the argument that this is all politically motivated to ensure that Donald Trump can't be elected. That's the argument that's going to be made. Trump, by the way, goes to court tomorrow in Miami at 3 p.m. But anyway, aside from all that, it's interesting because it seems like the folks peddling the bear narrative are grasping at straws. And I'm not suggesting there won't be a black swan, but let me just put it this way. I don't think right now, other than the inverted yield curve, there's so much terribly scary. And this flip from the Fed really reiterates that potential. And it's kind of mind-blowing to me. Kind of mind-blowing. So I want to be, as I say, the cautious optimist. But the more studying we do, and I think together, the more we discuss this, the more we start realizing the Fed is not trying to destroy this economy. And that is going to be statistically very, very good for the stock market, which is also quite strange because it doesn't feel like we should be hitting, all-time highs over the last year. I guess that's 1 year highs, those aren't all-time highs. But soon enough, we will probably surpass November of 2021. And I think people are going to lose their mind if the stock market surpasses November of 2021 and goes back to sort of this euphoric era without some kind of recession first. But you know what? I'm here for it. So, with that said, have I reminded you about our paid promotions like StreamYard? StreamYard is what I'm bringing this content to you by. I could throw up little banners like paid promotion. I could throw up little screens around the edge if I wanted to. Take a look at this. Take advantage of a special price on the courses I'm building your wealth, link down below. You can also use buy now, pay later now, which is kind of cool. I'd say maybe about 30% of people are using Klarna, Afterpay, Affirm to check out on the courses. Although you can get in pretty, I would say overall inexpensively for the value you get. And you get lifetime access. You get our course member live stream, which we'll be going to after this stream. And I look forward to seeing you there. So check that out. Link down below. We've also got some other links down below. Another link down below that I really wanted to point out is actually a new one. See this device? Well, actually, the camera that I'm filming on, and I'm still playing with some of the settings on this, so I still have some learning to do. But what's really incredible is I have this little thing called an Insta. What is this thing called? I don't know. Just go to metkevin.com/webcam, and so I have this new camera that will actually follow my head where I go. You can see that, and so I have my hands free right here, and this camera will actually follow me where I'm going. Oh, I disabled it by doing visual commands. So you can actually also disable this with visual commands. Like I can put my finger up like this, and then it flashes blue to acknowledge me. And then hold on, let me make sure I'm doing it right. Something to this effect, and then I should be able to. Is it going to work? Somehow. That's probably there it zoomed in a little bit. It's on face tracking, so I saw it zoom out again right away. But the point is, you could do like these hand signals, and it'll zoom in and out. I really think the face tracking thing is pretty cool though, because it just keeps you centered in here, and it zooms in on you as you move around. I don't want to cause anyone queasiness, but it's really cool device. So check that out. metkevin.com/webcam. It's probably, I would argue, the best webcam that I've used, and I've been traveling quite a bit. I think I've tried about 5 different webcams. There was actually a point where I just resigned myself to using the Mac webcam, but then I was in New York and I had this massive glare and I couldn't get rid of it because it's just a computer webcam. And I'm like, I need to get a better camera, so I finally did, and here it is, metkevin.com/webcam. All right, so that concludes that Fed piece. Let's now jump on over and see what CNBC has to say. Thanks to StreamYard for allowing us to do this pretty painlessly usually. So there we go. And let's remove this one. And I gotta unpause it. That is my fault. Okay. So let's give CNBC a listen. Let's play this live. Once this comes up, we'll listen to CNBC, or I might have to refresh that.
Third-party certification that if a manufacturer can make representations.
Who remembers this guy? This guy was always on TV during COVID. He was always on TV. Wasn't he on? He's on the Pfizer board. He was on the Pfizer board, which this, looking back, it's so crazy. But this guy is on the board of Pfizer, and he was on every TV, like every single day during the pandemic, making sure to remind us to take our shot. Well, that was when the shot was available, but also, providing a lot of their insight, I should say, during the what's it called? During the pandemic. Boy, that was a crazy time. But yeah, I don't really care to listen over there onto COVID right now, or COVID stuff. So instead, why don't we jump on over to what Morgan Stanley says? Specifically, Mike Wilson, who's one of the more famous bears. Is there any AI in it? They are branding it as an AI camera because you have to brand everything as AI. I think what they're trying to say is this camera's AI because it's supposed to be able to pick up let's see if I can get it to work again. I think when I have face tracking on, that doesn't work actually. So let me turn off the face tracking. Let's see if I can do it. So I'm supposed to go make this loser sign and then go up. No, I couldn't get it to work. I can't get it up again. It's a little tricky. I also don't know if it's valuable, but let's try. There. Oh, it zoomed in a little bit. That was kind of lame though. I don't know that it's necessary to do those sort of things, but I still think I solely like the tracking. It's also a 4K camera, but I'm filming in 720 right now. Okay, so let's go jump into Morgan Stanley. Okie dokie, Morgan Stanley. Let's see what we have. Oh, you bear. You're such a bear. It's okay though. It's all right to be a bear. Somebody's got to do the job. Somebody's got to do the job of a bear because if nobody does the job of a bear, then I will turn into a bear. You know what? One of the funniest thing was I'm gonna take a sip of this. I have an employee who loves being contrarian, and he has great insights. He's really good. He's been bearish almost all year, since actually pretty much the beginning of last year as well. Somewhere on November, December, 2021. He's been pretty bearish, and he's also a big fan of being contrarian. And lately, he's been feeling, oh my gosh, everyone around me is a bear. Like, in other words, when he's researching or studying or whatever, or reading reports, whatever it is, he's like, oh my gosh, everyone's bearish. And so he makes this argument. He's like, oh no, I've been caught as a contrarian in a room of contrarians. And so the irony is like, wait a minute, if you're a bear because you thought you were contrarian, but everybody's a bear, are you really a contrarian? And it's this funny irony. And so we joke about it. But anyway, I guess as finance people, we think that's funny. But it's probably just a lame joke. But yeah, it is really interesting because there is a lot of bearish sentiment, especially amongst, I would say, people. I would say some of the people who are more prone to be bearish right now are actually, I would say, people who are above 40 years old. And that's not to be, how should I say, I'm not trying to be ageist here, but I think that people above 40 years old who are bears right now are potentially bearish because they have that ingrained memory of how horrible 2008 was, or maybe even the dot-com era, or if you're older and you remember how terrible the late 70s and early 80s were in terms of recession, or even the S&L crisis, which a lot of people skip over when it comes to talking about Fed recessions and that. But you look at the savings and loan crisis and how terrible that, real estate crisis was in the late 80s, your 87, 88, 89, then you're very jaded to economic pain. And it wouldn't make sense that, quote unquote, words this time is different, that this time would be different. It just doesn't make sense. So when you look at how inverted the yield curve is, there is this complete explanation to say, look, I might not know what's going on, but I know how I felt in the past, and I know what the bond market is saying via the inverted yield curve, and this is bad. That's a strong argument that the bears have, And we're going to look at what Morgan Stanley's biggest bear, Mike Wilson, has to say in just a moment. But it is interesting that if history potentially jades older folks into being more bearish, then there is a real risk that they potentially just completely miss out on this recovery in the stock market, which would be quite disappointing, especially for those whom are older, because those who are older would likely have more of their retirement at risk, and so the risk of actually not being in the market might be substantially greater than trying to play the timing of it based on sort of this intuition, because quite frankly, the inverted yield curve, you could explain it away very quickly. And look, this is going to be a bear piece. We're going to look into Morgan Stanley's bear argument here, Mike Wilson's best bear argument we're going to look at. But I want to say one thing before I talk about Morgan Stanley's best bear argument. Why would the yield curve be inverted? Well, the yield curve practically is inverted when the 2-year yield is higher than the 10-year yield, right? Why might that be? Well, what if the yield curve is actually so inverted? Because in this cycle, markets have actually come to believe that inflation will prove to be transitory. Well, if markets believe that inflation will prove to be transitory, then you're going to have high inflation for, this year, the last 12 months and the next 12 months, and you're going to be able to capitalize on higher bond yields. I should say you're going to demand higher bond yields. So in other words, you're not going to buy the 2-year bond unless you're getting compensated more because inflation is high. So the market is actually requiring higher compensation now because inflation is high now. But the market is willing to take lower compensation in the 10-year on a year-by-year basis because we expect inflation to go down. So ironically, you can yet again dismantle the inverted yield curve simply by making the argument that, well, of course, if inflation is going to be high for a couple years here and then lower in the future, of course people are going to buy the 2 years unless they have a higher nominal yield than the 10-year. Was otherwise, yeah. Anyway, so let's get into the bear piece. I don't want to belabor that too much. Let's get into Morgan Stanley's bear piece here. Let's see what's going on. What we have to say over here. So this is Morgan Stanley's biggest bear. It's Mr. Mike Wilson. I think he's smart, but I think he's so smart that he's buried himself into this bearish corner, and he just can't get out. He just can't get out. So what does he say this time? And I want to be clear when he published this. This was published the 11th, so yesterday evening-ish, since that was where would they be more? Whatever. Last week, we released our mid-year outlooks for strategy and economics. For U.S. equities, our key differentiated view now centers on our well below consensus earnings forecast for 2023, followed by a forecast for a sharp EPS recovery in 2024. Okay, so let me translate that to English because that was pretty ridiculous. So in terms of like the language here, let's simplify this language. Morgan Stanley's biggest bear is telling you that the earnings recession in 2023 is going to be really painful, but then there's going to be this massive recovery in earnings per share next year. And now what I've done yesterday is I've made this argument, and I want to compare that to what Morgan Stanley here says. I made this argument yesterday that you have 3 scenarios. The 3 scenarios are that either the Fed completely pauses and chills and eventually cuts rates, which is going to be great for stocks. That's the bullish argument. The base argument is that maybe the Fed's got another hike in it or 2 hikes in it. And quite frankly, even if the Fed has another hike or 2 in it, I think the market will probably just keep marching on. It's like, John Brown's body, the glory just keeps marching on, okay? And then there's the bear case, which is we go into recession, you have this earnings recession, and you have more job loss, in which case the Fed will likely cut rates anyway, which probably will also be bullish for markets because, well, just look at Germany. I suppose there is a 4th scenario, which is stagflation, which is where inflation runs hot, which disallows the Fed from cutting while you have an earnings recession. Okay, fine. That would be a potential 4th case. So But again, we want to evaluate where is the inflation coming from to support stagflation. And right now, we're not seeing that. But let's keep listening here. So what do we have here? Morgan Stanley's Mike Wilson says, for the past several years, our overarching view on the markets has been shaped by our hotter but shorter cycle framework. And this is basically where he's saying, like, hey, this cycle is going to be very similar to the World War II, the end of World War II, where basically what happened at the end of World War II was you had this really big buildup of excess savings. And because people had so much extra money, at the same time that manufacturers were focused on building guns instead of butter, right? Guns and butter, the old school version of that. Uh, Manufacturers were not able to basically fulfill orders as easily for goods, and there weren't as many laborers in the correct positions yet to fulfill services. So you had what was a post World War II inflationary boom. And this post World War II inflationary boom was seen as very similar to post COVID. And what's interesting is post COVID, listen to what Morgan Stanley suggests happens. He suggests that in each case, after that is post-COVID and post-World War II, fundamentals and asset prices return to their prior cycle highs at a historically rapid pace. Now, the boom in inflation and earnings in 2021, which we forecast well in advance, eventually led the Fed to tighten policy at its fastest pace in 40 years. This boom and the Fed reaction proved surprising to many. Now, we suspect many will be surprised again by the depth of the earnings decline in 2023, as well as the subsequent rebound in 2024. So, in other words, he thinks that there's going to be this really short and rapid bust and then boom again. And that's because he thinks we're going to go from boom of 2021 to bust of 2023 and boom again in 2024. Somehow he thinks we're going to pendulum swing to the other side so very, very rapidly that this earnings recession is going to be so bad that you won't even want to be in stocks for it, but it's going to recover very rapidly, so be careful not to be in it. It's kind of a really weird argument. And I'll tell you, almost every time I read Morgan Stanley's Mike Wilson, I feel his bearish argument becoming weaker. I hate to say it, okay? But I mean, you can read the piece here. You've seen every word of this so far. We'll keep going here. But let's keep going. The boom bust period that began in 2020 is currently in the bust part of the earnings cycle, a dynamic that we believe has yet to be priced in during this bear market that began 18 months ago, and is largely related to just higher interest rates. In other words, margins and earnings will decline rapidly as inflation falls. So be careful what you wish for. Very interesting argument, because there's this argument that, hey, wait a minute. All y'all bulls want inflation to go down, but don't worry, when it does, oh boy, it's going to also kill earnings. Well, I'm going to talk about that in a moment in terms of where, but let's keep going. We think many investors are making two key assumptions that may be at risk. First, the impact of interest rates on growth is behind us. This is assumption number one. In other words, assumption number one is interest rates have already affected us. And assumption number two of the bulls is that several areas of the market, including consumer cyclicals, tech, and consumer communication services, have already had earnings recessions last year. I've actually mentioned this. I am a bull, and I have mentioned this. I have mentioned that we already had an earnings recession. You look at like Nike and the chips and stuff, you've already seen this. This is true, and therefore are likely to see accelerated earnings growth even as other parts of the market suffer. True. In fact, now this is Morgan Stanley responding, that reacceleration is now built into consensus. It's basically saying, yeah, but the market's already pricing in that rebound. In other words, you've got Morgan Stanley now responding with, we think this consensus view stems mostly from some large companies sounding more optimistic and artificial intelligence and what it means for both growth and productivity. While individual stocks will undoubtedly deliver accelerating growth from spending on AI, we do not think it will be enough to change the trajectory of the overall cyclical earnings trend in a meaningful way. Instead, it may pressure margins further. Oops, I put some charts in here. For companies who decide to invest in AI despite flat or decelerating top line growth in the near term. Okay, this is such an incredible mind twist of Mr. Bear here that we have to pause for a moment and think about what the hell he just said. He literally just said that some companies are going to spend money on artificial intelligence, and because they spend money investing in AI, they're actually going to end up having even worse earnings because they're going to waste money on AI and it's not going to work. Oh boy, you really have to be a bear to make that argument, don't you? Let me rephrase that one more time. Use the coupon code linked down below to always lock in Kevin's perspectives for life. Every day the market is open. We do our course member fundamental analysis together. We're applying artificial intelligence to all of the courses over the next month and a half here. So we're having a massive refresh. Next price increase expires and occurs on June 16th here. So we'll have a big expiration here on June 16th. It's just 4 days away. So buckle up. And we already got some amazing AI courses out or lectures out. Remember, we've got many different courses. We've got real estate investing, 0 to millionaire, stocks and psychology of money on the investing side. Then, of course, we have the income side. So you want to make more money as an employee or an entrepreneur, check that out as well. Okay, so with that said, think about what Morgan Stanley just argued, Mike Wilson. They made the argument that, okay, fine, artificial intelligence is actually hurting our bear thesis, but did you know there are going to be companies who are going to waste money on AI and it's not going to be very productive, and that's going to feed right back into the bearish narrative of an earnings recession and earnings falling. That's a pretty damn weak argument for a bear. I have to say, that's a very, very weak argument. I see what he's saying, but it's incredibly weak, okay? We note that earnings recessions over the past 70 years have often bottomed close to 17% in terms of earnings growth, the exact decline we're forecasting for 2023. This estimate is based on output from our earnings models, which capture the timing and magnitude of the deceleration in earnings growth we have seen so far in the cycle. The historical analysis suggests it's unlikely that the earnings recession will stop and reverse at its current levels, giving us the confidence in our estimates. Finally, earnings quality, as measured by net income to cash flow, recently reached its weakest level in the past 25 years. We see this as yet another warning sign that earnings growth will deteriorate further as the cycle turns and accounting policies reverse/are reset to more conservative assumptions. We further note that over-earning during the pandemic and the low quality of those earnings is broad-based. In other words, a lot of companies are going to have really bad comparisons to the last few years because they made money even though they probably weren't supposed to make money because everybody made money because of COVID. As we head into 2024, we see the market processing a much healthier earnings backdrop, and note that our 2024 earnings estimate growth is plus 23%. Okay, so he's so bearish, he's extremely bullish on 2024. This is so bizarre to me. I find it so bizarre that Morgan Stanley is holding on to this bear argument so strongly that they have to go as far as saying that, well, some companies are going to waste money on AI, man, and but don't worry, 2024 is going to be great. We're a bull in the long run, but it's just going to be bad in the short term. Okay, all right, Mr. Morgan. For investors who agree with our earnings path, they may decide to simply look through the downside this year. However, given where valuations are today, we think that is a risky strategy. This is him basically saying, look, we don't think you should be in stocks right now, and we think you should be careful for 2023. But in the long run, earnings are going to be great. So let me summarize the really horrible bear argument. The really horrible bear argument is, hey, you need to pick stocks because some stocks are going to waste their money on AI and some stocks aren't going to do enough or going to do well enough. In fact, remember right here, he says individual stocks will undoubtedly deliver accelerated growth, right? So some stocks are going to do great. A lot of stocks are going to do poorly. But in 2024, everything's going to go to the moon. That's the biggest bear argument on Wall Street right now. I don't think you can find. I mean, I'm sure. I mean, Jeffrey Gundlach is another big bear, but he's a bond market, technician, and I don't blame him for using the bond market to say, dude, the yield curve is so inverted. Just wait for it to reinvert. You're gonna have a massive recession, and that's probably the other bear argument that Morgan Stanley isn't even bringing up over here. Well, Mike Wilson at Morgan Stanley, but again, a lot of that inverted yield curve can be explained away by Of course, if we're going to have high inflation for 2022 and 2023 and maybe into 2024, you're going to demand a higher yield on your 2-year. Because why would you put a dime into a 2-year bond if the 10-year will compensate you more? You wouldn't. So you wouldn't buy the 10-year, or sorry, you wouldn't buy the 2-year until the yield is higher because inflation is high right now. Which means when people don't buy a bond, the yield goes up. And then the yield rises to the point where people actually start buying it. So it's quite remarkable when we consider that this is supposed to be one of the biggest bears on Wall Street, and it's just not looking good. And then of course we have Commodity Steve, a fellow Canadian, suggesting that lithium will still be in high demand. So remember to check out your rocks. And he's not wrong. Lithium will absolutely still be in high demand. I agree with that. Let's see here. Second wave. Okay, and then Steve does reiterate this part of the bear narrative, which is that the second wave of inflation is going to come due to a reduction of capex spending on future growth across multiple sectors. Are you suggesting a decline in productivity? That's an interesting argument. A second wave of inflation is going to come due to a reduction of capex spend on future growth. Well, if you don't invest into future growth, you're basically reducing your future productivity. Look, I would argue, and I think this applies to both what Steve is saying and what Mike Wilson is saying. I would make the argument that you really are going to see some companies suffer. I believe, and I've believed this for a very long period of time, probably about 8 months, that the consumer staples have had their run. Okay, they had their safety run at the beginning of 2022. They had their lingering price increases, but the days of Coca-Cola, Walmart, McDonald's, Target, Costco, the days of these staples, Home Depot, Lowe's, Kimberly-Clark, Procter and Gamble, 3M, the days of the staples are over. Walgreens, the staples are done. Honestly, most of them have been on a downtrend for the last 6-7 months. They've sat out the tech rally, and so now I'm a little weirded out because 6-7 months ago I was basically all in on chips and tech. But now chips and tech have run so much to where the peg ratios are starting to get out of whack again. I like to buy with a peg around like 1.6, 1.7. Tesla's above that now. The chip companies are all above that now. Although, it remains to be seen what the actual growth will be of these chip companies. That's the other question is like, how do you calculate earnings growth when what's driving growth keeps changing? And so there's this question like, well, is artificial intelligence spending just going to create one cycle of massive revenue for a company like NVIDIA? Or is this going to be, multiple years of adjusted revenue up? Who knows? Stephen Mike sitting in a tree, Kissing. Oh my God. Kindergarten's in the house here. Okay. I'm suggesting that companies are not investing in their future because of the high cost of capital, i.e., supply will not increase in the future. Okay, yeah. So that's actually an interesting argument that because it's so expensive to basically access working capital right now, it might make less sense to invest in machinery or whatever going forward. I think as a counter argument, I think you might be slightly over evaluating how much interest spend affects some of the larger drivers of innovation today. I think that most of the large companies today that are really driving productivity see interest expenses as a really nominal sort of footnote on their income statement. It would be worth looking at each company individually. Like, I don't think that's true for cruise lines, right? For cruise lines, interest expense is massive. For a company like Disney, interest expenses is a massive expense. But then when you look at a company like Apple or some of the other technology companies, interest expense is relatively nominal to where it would be interesting to look at the manufacturers though. Maybe look at like a TSM, right? How much does interest really affect them? I'm not entirely convinced that the drivers there are not going to double down on investment, because the problem is as soon as you stop investing, companies know that they're sacrificing short-term gain for basically long-term loss. And that doesn't tend to be rewarded very well. So you can probably cherry pick companies around that, but that's not a terrible argument. Some businesses are seeing productivity increases, but it's not coming from the downstream, i.e., the companies that produce the raw materials. Yeah. I suppose we'll see how it plays out, but I would go company by company on that. Small businesses are cutting OpEx, and some people say we'll push up unemployment. Sure, but then you also have this sort of idea of labor hoarding, and I believe that there'll be some cutting of jobs, but then there's so many job openings as well. Um, the other thing too is it makes you wonder, you know, small businesses, at what capacity are they always going to be able to survive? Small business turnover is just by the virtue of small business very, very high. And I say the virtue of small business because if your small business is really, really good, you don't stay a small business very long often. That's not always true, right? There's some people who are very content operating their small business. Like, let's say you're an electrician. Well, generally, like you operate a small business, you've got 2 or 3 electricians with you, you could be content with that. But often, the next generation or whatever wants to take that business model and the brand and start expanding it to different areas. And all of a sudden, your small business turns into a business where you have, 100 electricians trucks driving around under your brand. So small businesses, often rise and grow up to become medium-sized businesses. It becomes very interesting. And then a lot of small businesses fail is the argument of that. But small businesses failing is not a surprise. That's not necessarily news, is I suppose what I'm saying there. Anyway, so yeah, okay, fascinating, I suppose, piece from the Bears here. Not very robust in my opinion. The arguments are very, very weak right now. I'm still looking for strong arguments from the Bears because again, I agree that it is weird that things are just going so Goldilockish right now. I'm not trying to be blinded by optimism, right? I'm really trying to be realistic. And we do this when we do our fundamental analysis daily in the course member lives, which Steve is an honorable course member as well. He's there debating with us. Thank you, Steve. Remember to use that coupon code. We've got a big expiration coming Friday. It's going to be a big one, really, because I'm going to announce probably within the next 24 hours exactly what we're going to change. Rough framework is that we're doing a pretty massive update to the Zero to Millionaire real estate investing course and the Stocks and Psychology of Money group, where we'll probably go through and we'll add a bunch of lectures in the original sort of outline of the course to provide Kevin's old perspective with Kevin's sort of 2023 perspective. And it'll be really interesting to see both. A lot of people are begging, please keep both the old lectures and the new, so you can kind of see both perspectives. And they're going to be very similar, but they'll be said in slightly different way. And the new lectures will be updated with artificial intelligence. Both will be incredibly educational, so it'll be quite fun. So I'm very excited about that. So, okay, let's jump on over. You require additional capital expenditure for AI adoption, right? So, while future growth might have initial costs, AI will eventually provide more compensation. AI can hurt earnings short term. The question is how much, though, right? Because how much does it really cost to invest in AI? I mean, if you just move your employees over and you say, hey, take Kevin's course on productivity and making more money, and you take that course, it's not actually going to be that expensive for you to implement AI to be more productive in your life. Every single person watching this video right now, every single person, employee, self-employed, retired, entrepreneur, what I don't really care who you are, what you do, every single one, I'm confident, will find something incredibly useful in the AI lectures in the how to make more money and get SH9T done faster course. Just go to meetkevin.com. It's the first one that shows up on the banner there. I guarantee it. And it's not expensive to implement at all. What's expensive to implement would be like new manufacturing machines or servers or whatever. But that's not on you. That's on big business, right? All right, let's listen to CNBC for a moment. Let's see what they're possibly yapping about.
Under the deal, it intends to issue about 14.5% of its outstanding shares to Adenza's owners. NASDAQ's about a $28 billion market cap stock, 10.5 here, and probably 3 times as big as any acquisition the NASDAQ has done in the past. And we know the NASDAQ has been diversifying. Obviously, if you live and die with the IPO market or this, just how hot the stock market is, that's not a business where you can count on.
Pretty cyclical, right?
Yeah, it's pretty cyclical. So.
Yeah. Obviously, Adina said she'd be talking to shareholders later this morning. Those are some of the questions that they'll be asking too.
She did. I asked about 600 in sales on 10.5 billion, but then she did the EBITDA number, the price to EBITDA, which was more reasonable. But I guess shareholders at this point, they are issuing quite a bit of or going to use stock, so that might make sense. I don't know. Is it recovered a little, Becky? Is that where it was when
no, that's about where it was when we spoke with her. Yeah, it was.
I don't know whether that.
It was down 7.55 or 7.95.
There's ARBs, right? It doesn't necessarily mean they're overpaying at this point. Could be seen as that, but or they want more input on the deal. It's kind of knee-jerk.
I think at 8%. I think at 8% down, this is beyond. I think a 2 or 3% move, that's an arbitrage move. I think that this is a move where there's folks saying either maybe they're overpaying, or we don't like the business, or we don't understand the combination. I think there is something, unfortunately, going on there.
Right. Well, no bacon for you, then, so that's not going to happen.
Well, it was somewhat boring NASDAQ buying company. I want some juicy stuff from CNBC. This wasn't juicy. We need juiciness. All right, fine. We'll find some of our own juiciness. So let's see what we got here. Yeah. Oh, wow. The piece we talked about earlier is actually front page on Bloomberg right now. So if you just go to Bloomberg.com, I'll just describe it to you. You don't have to go there yourself. But if you go to Bloomberg.com, front page, right in the middle, Fed backs away from wages focus, bolstering case for rate pause. That's what we talked about. And I'll tell you, that is really, really good. That's fantastic. Really, really good. Then they also have the Morgan Stanley piece that we talked about, which is great. We already broke that down and went through the bear narrative. So what else do we have here? Let's go to, I thought this was an interesting piece. We can look at this one together. We'll share the screen on this one. Give me a second here. We're going to go ahead and add a little tab here. This is the beautiful thing about, there we go, about StreamYard, metkevin.com/StreamYard to learn more about this software. But you can actually share a specific Chrome tab, which is kind of cool. Rather than sharing your whole window, you could just share a tab. So check out that paid promotion by going to metkevin.com/StreamYard and check out how StreamYard functions. But it's pretty cool, paid promotion. But anyway, take a look at this. Tesla's shrewdest product is proving to be its charging network. Now, what I think is so incredible is that the mainstream media has this really hard time saying nice things about Tesla. In fact, most of the time, you end up getting the mainstream media trying to be as negative as possible about Tesla. It's pretty incredible. In fact, if you jump over to this story, I'm going to show you the Washington Post. They had this horrible bear piece in their paper. This is a company owned by Jeff Bezos. And then Jeff Bezos and Musk, they've had their rivalries. But anyway, here's this horrible piece basically outlining how you have 17 fatalities and 736 crashes, the shocking toll of Tesla's autopilot. And they give these stories and anecdotes about how horrible autopilot is and such, and these accidents that have occurred. And what's really missed is the fact that, even if you attribute some accidents to autopilot, when you actually compare Teslas to regular vehicles, you find that 99.97% of vehicles and vehicle accidents are caused by humans, not by machines. And even still then, when you directly compare miles driven in a Tesla on autopilot versus not, the miles driven on autopilot are 10 times safer miles than not on autopilot. So I don't think anybody is alleging that systems are perfect, but what's remarkable is the narrative to find at any cost what you can do to bag on Tesla. But slowly, I think the mainstream media is realizing, wait a minute, maybe they're doing something right. And I find it interesting that Bloomberg is trying to compliment Tesla on their charging network, but they're trying to do it in almost a backhanded way by arguing that, okay, all right. So maybe the reason Tesla does have a fair high valuation is because their charging network is good. Let's take a listen to what they have to say here. Tesla's shrewdest product is proving to be its charging network, which I actually don't think that's its shrewdest product. I think it's if we make the argument of what is the well, think about what is the definition of shrewd, right? Shrewd is being astute or having good judgment. Let's go with that, right? So having very good judgment. Well, what would be very good judgment is betting on the future of autonomy and self-driving. So I would make the argument that FSD is the shrewdest. So, in my opinion, when you look at a headline like this, what they're really doing is they're trying to sort of backhandedly say, okay, yeah, Tesla's only doing good now because, well, they got lucky with their chargers. That's somewhat the tone of the beginning of this, but let's go into it. Someone needed a quick charge driving over to the Santa Cruz Mountains for his Ford F-150 Lightning, so he pulled into a Tesla supercharger, which has 16 stalls. It's just one of 2 locations on the West Coast that is open to drivers with the latest innovation from Tesla, the Magic Dock. The Magic Dock is a Tesla connector that allows other EVs to use the company's exclusive charging network. It's hardware that's added to the charging system itself. There's no need for drivers to carry an adapter in the truck. I plug it into my truck and it just works, says this person. You hear the magic dock click and latch into place and it starts charging. It's beautiful. Tesla, known for its electric cars, blah, 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 okay. But Tesla's low-key, ubiquitous superchargers, which now cover much of North America, Asia, Europe, and the Middle East, are proving to be the shrewdest, most strategic product of all. Tesla dominates EV sales in the US, not surprisingly, is conquering reliably fast charging. At the end of the quarter, the company had nearly 5,000 charging stations with more than 45,000 charging stalls, the little things you actually plug into. But it's not just the Magic Dock. In recent weeks, 2 Tesla rivals, Ford and GM, announced they will partner with Tesla on charging. Now, I just want to clarify something here. There's there were a few people that were leaving comments, rightfully so, correcting me in my last video on Tesla, where I made the argument that a lot of people would end up using the Tesla app to end up charging their non-Tesla. There is actually going to be API access for Ford and GM. I don't know if the Ford and GM apps will end up being what the consumer chooses to use, but that is a potential that you could use the Ford app to charge at the Tesla stall. I do think, however, there is a chance, there's a very real chance that people will end up continuing to use the Tesla app, because if I had my guess, I think the Ford app is going to be clunky and slower than the Tesla app. And if that's the case, people who drive Fords and GMs might actually still end up preferring the Tesla app because it'll end up being easier. I don't know. So shout out to Tesla for that, but also a warning for GM and Ford. You better make a fast and efficient app. Otherwise, people will use the Tesla app, which could reiterate this idea of Tesla just promoting to your customers that they should buy a Tesla instead. Kind of interesting. But anyway, continuing on here. In both cases, Ford and GM customers can buy a Tesla-made adapter that will allow them to access more than 12,000 superchargers starting early next year. Hasn't started just yet, so it's going to take some time for broad adoption. But anyway, Tesla's unique charging port will be built into Ford and GMs in the future. Selling a car is one thing, selling consumers an EV charging experience is another, and one that provides an ongoing revenue stream. Tesla may rake in as much as $3 billion per year from charging other manufacturers' electric vehicles by 2030. GM's CEO suggests that not only will it help make the transition to EVs more seamless, but it could help move the industry towards a single North American charging standard. This is compared to the standard that you have in Europe, which a lot of people just don't like. In fact, Elon Musk decried on Twitter that he was trying to convince them to use the North American standard, but they refused because the decision to use the European standard had already been decided by some committee years ago, to which, of course, Elon rolled his eyes. Because it's kind of like, well, if we have a better product, why wouldn't you change? Oh, well, because another committee has already made the decision years ago. Okay, Mr. Committee. Anyway, we don't want the Tesla supercharger network to be like a walled garden, Musk said during an event with Jim Farley, the CEO of Ford. We want to be supportive of electrification. It is the best ad for Teslas. I'll tell you, this is one of the greatest advertisement for Teslas. Anyway, Tesla is the largest installer of ultra-fast chargers in the US, according to Bloomberg NEF, accounting for 71% of charging installations in 2022. Wow, I did not even realize that. I mean, I knew there were a lot of other chargers, and I knew that Teslas were everywhere, but I didn't realize that when it comes to CapEx spend on chargers and charging installations in 2022, Tesla raked in 7 out of 10 of the installs. That's insane. And they forecast that electric vehicles in the US will make up 28% of passenger vehicle sales in 2026, up from 7.6% in 2022. More EVs on the road means more cars will be sharing the nation's superchargers. I continue to also see specifically a lot of older generations. I'm not seeing this so much amongst the younger generations. I do see it a little bit though. A lot of older generations are making the argument that, oh, well, why would you get an EV? It's not really that green anyway because you have to plug it in. And when you plug it in, guess what? That's driven by coal anyway. And that may be true. But when you actually look from an individual point of view, rather than this like green energy push point of view, when you look at an individual point of view, would you rather drive a car that gets 30 miles to the gallon or a car that gets 100 miles to the gallon? Well, in that case, that would be a Tesla. Would you rather get a car that needs service every 6 months, an ICE vehicle, an internal combustion engine, or one that almost never needs service, like an electric vehicle? Would you rather have a vehicle that's fast or slow? Would you rather have a vehicle with autonomy or not? And when you start putting those pieces of the puzzle together, you're like, yeah, those are all really good arguments for Teslas. Sorry. It's kind of incredible. Especially with the prices where they are now. Remember, we were doing this the other day. And I want to be clear about this because some other people were getting mad at me for not clarifying this. Some people were making this argument that I purposefully wasn't making this clear or whatever. No, I actually assumed that people already knew that. So forgive me for assuming that people knew this. But in order to get this $7,500 tax credit, you have to actually owe $7,500 in taxes. And quite frankly, I hope that if you're buying a Tesla, you owe at least $7,500 in federal taxes. but keep this in mind. Like, yes, this just lowers what you owe in taxes, right? But it's quite incredible because if you look at it, you could get a Model 3, which, by the way, you can go to metkevin.com, shameless plug, metkevin.com/Tesla. That's my referral link. So if you want to use a referral link, you could use anybody's you want, but obviously if you wanted to use mine, you could, and you could get $1,000 off an XS or get some loot box credit, which lets you buy some Tesla, fancy chargers or whatever. It's actually kind of cool when you get these loot box credits. Let me see what the credits are really quick, and then I want to do this math again here, and we'll keep going with it. Oh darn it, it's not sharing the screen. Poopy doopy. I was trying to share the screen, but I forgot to share the tab. That's my fault. There we go. Share this tab instead. There's this big banner of a button that says, do you want to share this tab instead? And I totally forgot to push it. But anyway, when you go to the Tesla loot box, I just bought myself, for example, Tesla shorts off this. But I'll tell you some of the things you can buy with this. I think the shorts were only like 500 loot box credits. Let's see here. Or maybe it was like 800 or something like that. But anyway, you can get these fancy superchargers. You can get home chargers with loot box credits, like a white wall charger, basically for free by using these award credits. Or you can use, or you can get a fancy black one. You can get shorts or whatever. They're a little more expensive than I thought. But anyway, you can get some things with it. I don't know how valuable the loot box credits are. If you want some Tesla merch, you can look. But anywho, the point is, regarding this tax credit, you have to owe money to be able to qualify for the tax credit. And then, of course, if you're using the California tax credits, the state ones, it's $2,000 unless you qualify for the upgrade, which in order to qualify for the upgrade, you have to be within 80% of the median income or whatever based on family size. So just go to the website to figure that out. Let me clarify that website. That website is cleanvehiclerebate.org. And you'll get the details there for California. But anyway, we'll continue with this piece here from Bloomberg. So continuing with this, more EVs on the road means that more cars will be sharing the nation's chargers. Fine. White House is eager to support the adoption. What's incredible here is I believe this $5 billion to build out supercharging will probably almost exclusively go to Tesla. Not only do I think it will almost exclusively go to Tesla, but I think that it's probably going to be a lot more than $5 billion. So I want you to think about that. Usually when the government says we're going to offer $5 billion to something, they end up vastly overspending on how much they want to give, because if they spend $5 billion on Tesla building superchargers, they're going to see a massive boost in EV adoption, and then they're going to think their return on investment is huge. And so I think the Biden administration will end up probably propping that $5 billion up by a lot. So I think the amount of money that superchargers are going to get from the Biden administration will be huge, absolutely huge. So we'll see what happens. This could also be another advertising opportunity for Tesla, is announcing these superchargers being available for others, but that could come more next year. I read this article earlier. There wasn't too terribly much more. They make this fallacious argument about Tesla having $22 billion in cash, which is relatively nonsense because they have a lot of bills to pay. They got like $23 billion in bills to pay. And I know they have vehicle inventory that they can sell, but still. Anyway, so I think this is pretty incredible. And a good little piece here from Bloomberg, somewhat backhanded because it's sort of like finally giving credit to Tesla, like the mainstream media is finally giving credit to Tesla, but they're doing so in like, see, the only reason Tesla went up is because of their supercharging network. People like to do that. It's kind of like the people that are like, oh, well, the only reason your portfolio did well is because of Tesla. And I always like to respond to that, and I go, you have to have diamond balls. Like let's just make a hypothetical example and say that hypothetically you were going to launch oh wow, that was funny. Let's say that hypothetically you were going to launch an ETF, and hypothetically you put a lot of that money into Tesla when it was really unpopular to do so, and you had the balls of steel to ride that sucker down to $103 in an actively managed fund, and then it skyrocketed from there. And then people have the audacity to say, oh, well, you just got lucky because of Tesla. That's rich. That's all I have to say about that. Okay. So, good news here for Tesla, obviously. And again, I think that the money that Tesla is going to get from supercharging is going to be a drop in the bucket compared to the money they'll get from other incentives from the government. Take a look at this here. Electric has a front page piece here. Tesla's North American charging standard enjoys a domino effect. And this is really where they're making the argument that, oh, you're going to see even more companies end up coming after the Tesla supercharging network to basically join it in a positive way very soon. Tesla has unveiled a new concept, by the way, called the Giga Laboratory to showcase its manufacturing prowess. Ooh. Anyway, Electric sometimes has some interesting arguments or pieces on Tesla, although surprisingly they've become a little bit more bearish on Tesla as of late. Oh, again, I didn't share the darn screen. My bad. It doesn't matter. So anyway, okay, let's jump into the next topic. I got to get a little bit better at operating this. My bad. All right, so that's a little bit of a talk on Tesla. Let's listen now into what CNBC has to say. So let's see what this dude has to say. I push this button, and then I need to hit unmute.
We are going to say, campaigns, sorry, you're not allowed to use generative AI anymore. We have a mechanism to get in the middle of that and the voters. And so I think that our members of Congress are going to have to start thinking very carefully in this new age of AI, how they want campaigns and politicians to either weaponize or take advantage of this technology. And in the interim, while we're trying to figure this new technology out, we at least have to start labeling everything so that we have a chance of dealing with it downstream when we do make some decisions.
What about where you see it? Do we need to assign more responsibility to people, whether it's Twitter or any social media site?
Okay.
We do the best that we can, but it's user generated, and we're not.
Keep in mind what they're doing here is they're really responding to these fake AI images of like the Ron DeSantis campaign using Trump kissing Fauci, and it's all just fake AI.
Why that Pentagon image went viral, and the reason why the stock market responded to the tune of $500 billion is because Twitter is handing out like candy $8 a month verified accounts. And it was a verified account that looked like Bloomberg that was then algorithmically favored, which was then allowed to be retweeted by known organizations that distort reality. And so Twitter has to take some responsibility for this. The Facebooks of the world have to take responsibility for this. And I think we have to start saying, if you are not just the people hosting this, but the ones algorithmically amplifying the lies and the conspiracies, we should hold you to account for that.
All right, we're going to pause on this a little bit. I want to get into more finance here, so let's focus on that. Let's take a look at what the Financial Times has to say today. So it's going to be very interesting. Obviously, what we have coming up with the calendar, we know that we have CPI tomorrow. That'll be in now under 24 hours from now. CPI will release. Then we're looking at PPI the very next morning at 5:30 a.m. Fed meeting tomorrow, 2 days from now. And then we'll have retail sales, ECB rate hike, 25 basis points expected, Bank of Japan rate decision expected. So a lot of drama coming this week. It's going to be a very, very fun week. I'm very excited about it. I'm also, by the way, I'd like to be open to suggestions for some new content for the courses. Again, we're going through a refresh now and it's totally free for existing course members, of the Stocks and Psychology Money and the Zero to Millionaire Real Estate course. Those are amazing, but we're going to incorporate AI into some new lectures, and we're going to make them very, very productive, these courses, even more so than they already are over the next few weeks here. And so in honor of that, we have a coupon expiring Friday, but I want to make sure I'm open to suggestions as well. So go to metkevin.com/chat. And then you can join the Discord and leave me a message there. Just tag me at @meetkevin. I go through all the tags pretty regularly. Okay, so let's see what else we have here. Financial Times. So if we jump on over to the Financial Times, let's see what the FT has to say for us today. Financial Times, we talk about the settlement between JP Morgan and regarding the Epstein lawsuit. We know that Donald Trump goes to court tomorrow at 3 p.m. in Miami. There's been a lot of this talk about China really having a false start and potentially lagging behind substantially. I've been anti-investing in China, but now it seems like it's becoming a more of a reality that China might actually end up being a global disinflationary anchor. But otherwise, not too much entertainment for a Monday morning. Let's try the Wall Street Journal. Let's see if Nick T has said anything. How about that? Let's jump on over to Nick T. He's always a good one to see. So the problem is trying to spell his name. Is this a Nick? Oh, it's a Nick P piece. Look at that. Nick T literally on the front page, front and center for us, folks. Front and center. Jerome Powell's big problem just got more complicated. Oh, this has got to be good. All right, we're going to do the Nick T piece together. You ready for this? This will be fun. We'll write this down. Nick T. So, all right. Let's do it this way. In case you're not familiar yet, I have a coupon code link down below that expires Friday on the 16th. But actually, in case you're not familiar yet with Nick T is basically the Fed's mouthpiece. Let's explain that. When the Federal Reserve wants to leak something to the press, we believe that they send a text message to this guy called Nick T. And it might be J Powell going, "Dear Nick T, pump it." And basically pump the market or dump the market. And then Nick T publishes a big piece on it. So because Nick T is known as the Fed mouthpiece, we like to analyze what he has to say. Well, it looks like he just dropped a new piece for us. And this, to me, is like seeing an update on RuneScape. It's like 2006, and it's RuneScape 2 days. And there's an update that's dropping from the JagX mods, and we're all like, what is it? What is the update? It's very exciting, so forgive me, but I'm quite happy about this. I'm so happy about this. I got to make sure my life insurance is updated, which you can get by going to metkevin.com/life, or 12 free stocks you can get by going to metkevin.com/free, and you can join Webull and get yourself 12 free stocks, all paid promotions. All right, so what does Nick T say? Federal Reserve Chairperson Jerome Powell finds himself in a place no central banker wants to be, averting a credit crunch which calls for looser monetary policy while fighting high inflation, which demands the opposite. This whole credit crunch stuff is nonsense, though. Strains in the banking industry, which followed the collapse of 3 mid-sized lenders this spring, help explain why some central bank officials are leaning towards holding interest rates steady. The banking crisis is we still have the bank term funding facility seeing increases in its usage. You could look at this. You could just type in bank term funding program facility. Let's get like a chart from St. Louis Fred. We should be able to grab this. I love that it shortens to basically buy the F and dip or the Fed pivot is what some people say. But you could see if you go to that chart, I'll share this tab instead. If you jump over here, you could see the liquidity facility. And the facility has only existed since March. So we're going to zoom in on this. And you can actually see that on a nominal basis, the bank term funding program is actually seeing more usage even just over the last weeks going through June 7th. See, look at that. In the first week of June, you actually saw an increase of about $7 billion in the Bank Term Funding Program, or Buy the Fed Pivot, which is actually leading to some concerns that maybe the banking crisis is still in a shadow way going on for some of the smaller banks. So something to pay attention to. Fed officials don't think that a crisis is imminent, attributing recent troubles to idiosyncrasies at three banks. That is like, in English, hey, yo, those three banks just sucked and everything else is fine. Don't worry, everything is just fine. Okay. But current and former Fed bankers say if stress is worsened, the Fed will face a more difficult trade-off. Powell and his colleagues would have to choose between focusing on failing banks or high inflation. They're between a rock and a hard place. Okay, old news. Where's the news here? One risk is timing. If inflation becomes entrenched in public psychology, that would be called your inflation expectation. Becoming self-perpetuating, that could force the Fed to hold short-term rates higher for longer. If inflation is going to fall quickly, we might be in a position to be able to cut rates. If not this year, then soon in the next year, says Neil Kashkari. But if, on the other hand, inflation is more persistent and more entrenched, I think stresses in the banking sector will probably become more serious. Potentially. We'll see. Economic expansion and legacy of Jay Powell are at stake. Fine. Separation principle, blah, blah, blah. Okay, what do we have here? During the pandemic, the Fed signaled plans to hold interest rates at very low levels for years to purchase trillions of bonds to spur additional borrowing and stimulate the economy. As inflation hit 9%, we started raising rates. Fine. Bank supervisors didn't quickly spot how much these rising rates had created a dangerous mismatch between their assets and markets, and that triggered run on the banks. Okay, this is all historical. Where's the news, man? Where's the news? In making these moves, central banks were operating under the so-called separation principle. They use emergency lending and regulatory tools to address financial instability so they could focus monetary policy on combating inflation. Fine. Okay, Nick T, come on, man. Give us something new here. Credit crunch could initially help by slowing pricing pressures, but the slowdown in credit growth could easily get out of control. Sure, but you're not really seeing that right now, other than if you're looking at like used cars. It's like the subprime auto sector. That's what's getting destroyed right now. Conventional wisdom holds that rising interest rates are good for banks while the value of the loans and securities declines. Fine, we already know this. Nick T, this is boring, man. Kashkari said he wasn't seeing evidence of a credit contraction in his district. I know, that's what I'm saying. Hanging onto the cliff with their fingernails. What are these quotes? What is this nonsense? Our tools can have separate objectives, okay? If inflation doesn't fall, investors could demand higher yields on medium-term and longer-term debt to compensate for the risks. Well, that's why we have an inverted yield curve. If you haven't yet contained inflation, you will have savings and loans problems all over again. So that's referring to the late 80s. Fed officials have suggested that even if they forego an increase this week, they could nudge rates higher at a future meeting. That's bullshit anyway. Fed officials are split over whether to raise this week, blah, blah, blah. This is boring, Nick T. You could do better than this. I'm going to have to send Nick T an email here and be like, come on, man. Where's the leak, man? That was boring. I'm sorry, folks. I bored you with a boring Nick T piece. That was really, I feel like that was just like a history of like, here's a history lesson. We lived it, dude. All right, let's listen to this.
Structure much quicker than the other charge point operators. And so they have the data on where, let's say, the prime locations are of customers, of their customers that are using their charging stations.
Good idea.
So I'm sure they're going to use that into their calculus of which charging areas become available to non-Tesla owners.
Okay. Mark, appreciate your time, perspective as always. Talk to you soon.
Thanks, Andrew.
That's actually an interesting argument. I mean, just the idea that Tesla can kind of see where all the demand is for where they should place more, superchargers. And I would argue they probably have the best research compared to, and even requests. Because the other thing to remember too is they'll get requests from companies that'll say, hey, we want you to put superchargers in our area. And so Tesla has to decide, okay, where do we want to put them all? It's actually quite fantastic if you think about it. Am I going to break things if I press this button? Hold on a sec. No, I don't think I broke anything. Did I break anything? I don't think I broke anything. Hold on, let me do it again. Well, I guess it doesn't really matter. I just set the camera's resolution to 1080. I guess I could set it to 4K as well. But I'm not changing the output quality anyway, so it doesn't matter. Ooh, there's 4K. I don't think you'll see a difference because I'm streaming it at 720. But anyway, I've been messing around with this webcam because it's awesome. If you want to see the one I'm using, check out my affiliate link, which is a paid promotion at metkevin.com/webcam. metkevin.com/webcam. The thing's actually been really good so far. So anyway, okay. Ooh, what is this? Okay, a Market Live blog. Hold on a sec. This is interesting. I see some talk about something interesting. Okay. All right, so we're going to call this the Market Live blog. Here we go. So what do we have here? Monopoly pricing power, a key risk for embedded inflation. Bigger companies have likely been used to their monopolistic position to raise prices under the cover of broad inflation. I love talking about big PP. You know, there's nothing better than big PP. You wake up in the morning, big PP. You want to wake up to big PP every day because if your companies have big pricing power, you know you're going to have a good day. Monopolistic pricing power. Increasing the risk that price growth becomes entrenched. Thus, longer-term monetary policy has to remain tighter. Ooh, another bear argument. So they're making this bearish argument that some companies will be able to continue to raise prices. The role of profit margins will be central to returning inflation to low and stable. They had been rising in the run-up to the pandemic, but exploded thereafter along with inflation. Okay, so what companies are we talking about here? One convincing argument is that a rising number of monopolistic and oligopolistic firms have allowed many of them to continue to raise pricing without impunity. Okay, what are some of these? They're calling this greedflation. So they didn't even give a single example here of a company. But it's interesting. I suppose you could make an argument that maybe some of the big chip companies have monopolistic or oligopolistic power, like NVIDIA, for example. You could argue that TSM, which manufactures 90% of the world's advanced chips, under like 4 nanometers, 4 and under nanometers for semiconductor spacing, if they control like 90% of the market, they're like a monopoly. You look at ASML, they're basically a monopoly for chip manufacturing equipment. To some extent, you could argue that Microsoft and Apple have some oligopolistic power. I suppose you could argue that they could continue to raise pricing. Okay, interesting. But I wish they gave some examples in their arguments. What else do they say here? S&P will soon face challenges, and it's not just the Fed. Oh, yeah? What? Options markets suggest that the current bout of risk exuberance appears to be a delta pull-driven rally. Hey, that's what I talked about yesterday. Positioning squeeze is likely. Blah, 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 blah. Yeah, whatever. Let's listen to CNBC. This stuff's boring. All right, let's go back over here.
Going up, it's going down, it's going up, it's going down. No one knows. But one thing I think is
I was not expecting to go to CNBC and just hear somebody go, "It's going up, it's going down, nobody knows." That sounds so dumb.
It's down inflation to its target.
You said that's the one thing you seize upon is that one thing we know, it probably will be higher for longer. But I mean, for months, we've pointed out the disconnect between the 10-year and even the 2-year and what the Fed was saying it was going to do, as if the markets had some higher knowledge than the rest of us. Now, you're saying when the gaps narrow and the markets come up to where they should have been all along, that was all just a head fake. The markets just didn't know either. So you really can't. Then we can't listen or get indications from anywhere.
Well, I think the bond market has it probably more right than the equity market does. I mean, you look at the inverted yield curve, and that's a sign right there that, the Fed's doing its job. I mean, that's what the Fed tries to do, right? They hike rates aggressively to slow long-term growth and inflation. That's why you get an inverted yield curve, because the front end represents Fed policy and the back end represents growth and inflation. So you'd expect an inverted yield curve when the Fed gets aggressive. You wouldn't necessarily expect risk assets, whether that be corporate credit on the fixed income side or cyclical equities on the stock market side. You wouldn't expect those to do particularly well during this inversion. Listen, I think it's clear though that the Fed ultimately needs to bring down growth and inflation, and so I think the bond market probably has it right here.
Yeah, but the bond market probably has it right. Bond market's forecasting. I mean, we thought there were going to be cuts at the end of this year. Now that's not happening again? Is it still possible?
It's possible. Listen, I think it's a pretty binary situation. Either you're going to get a lot of cuts because the unemployment rate spikes, and I think investors really need to recognize that the Fed's not going to cut just because inflation comes back down. The Fed is only going to cut if growth really rolls over and unemployment spikes. So to the extent that that happens in the back half of the year, then the Fed could absolutely be cutting by year end. But if you look at the resilience of the labor market and the structural labor shortage that we have here, I think this is probably more of a 2024 event than a 2023 event.
What's that C stand for? Is that Contopoulos or
I was wondering too.
University of Cincinnati?
Yeah, I got that as a gift.
Cornell?
I think it's Contopoulos, yeah.
He doesn't even know.
Or not Big Red or anything like that? Or
Nothing
UConn?
like that.
No.
You got my Columbia Lion behind me.
Columbia? Okay, yeah, it could be all those things. Michael, thank you.
All those things.
Okay.
Absolutely, thank you.
All right. We are out of here in about 9 seconds. We're still, Andrew, we're holding on to paltry gains. Fed meeting starts.
Yeah, paltry gains. I just want to jump back into this idea of the Fed over here and the inverted yield curve. Just consider this for a moment. So just to draw this out, the 2-year right now is 4.569. The 10-year is 3.71 right now. And so what you're saying is, hey, if I'm going to lock my money up here, and let's say average inflation is, 4%, right? So let's say inflation averages 4% from, call it mid 22 all the way through mid 24. Okay. So let's say inflation averages this. Well, if inflation averages 4%, you're going to want to make something on your money, right? So the bond market says, look, if we think inflation is going to average 4% for 2 years, why would we buy the 2-year bonds if the yield is under 4%? Well, you don't. So you wait for the 2-year yield to go above 2%. By waiting, less people buy. When less people buy, and this is important to remember about bonds, when less people buy, yield goes up. All right? So less buying, yield goes up. So in other words, when people are like, nah, 4% isn't good enough yet, and less people buy, the yield goes up until at some point it becomes good enough. Okay? So when you just look strictly from a market point of view, it makes sense that the 2-year is here. Now you look and say, okay, well, how much do I want to be compensated on a 10-year? Well, if you look and you say, well, I think over the next 10 years, inflation is going to average 2.5%. Let's just say. Well, let's say you're willing to take a little bit of a premium over that of, say, what it is now, 1.2% or whatever. Well, then that's how you create the 10-year market pricing. So if you look at these independently, there is the potential market driver that actually just naturally creates the inversion because inflation is high now and it's not expected to be high in the future. Just by the virtue of that, you created an inverted yield curve. Now, generally, that is a signal of a recession. And so that's the big confusion, right? Because generally an inversion of the yield curve, especially at this level, predicts a recession. Let's listen to Jimbo for a second.
Or on analysts recommending it today that are supporting why? AI. Salesforce, new products announced today. Why? AI. Now, do you see a theme?
Do you take it as a negative because it's reflective of a certain amount of froth in the marketplace, given obviously we don't know what the ultimate
I don't want
impact on revenues and earnings from any of these companies
That's true.
AI
We don't know.
will be?
But I don't want to be in the Mr. Wilson camp, but yes, I think it is because we need one of the things that they need with AI, and this is true.
Do you hear him say the Mr. Wilson camp? That's Morgan Stanley.
Well, aren't there going to be a lot of customers?
Yeah, well, you're a customer because you think the other guy might be a customer.
Right.
And you have to use the consultancies, which is Google. You got to go to Oracle, Microsoft. So you hire them like you would have hired EY or Accenture in the old days. And say, look, please help us, please. Adobe, there's a recommendation of Adobe as if the Adobe hasn't run enough.
I feel like a lot of these analysts are just catching up.
I said that this morning to my team.
We'll follow some of them, but listen, there are moments when analysts are worth listening to, and then it's sort of like, all right, great.
And
You're upgrading Oracle now?
I know. The most exciting piece was the Goldman we got oil wrong, and we're going to continue to get it wrong until we get it right, which I thought was a novel way to be able to do research.
It is.
We're wrong, but believe me, we stick with it long enough.
One day we're going to be right.
Yeah, one day we'll be right.
Okay.
David,
honestly, that's basically exactly how I feel about Morgan Stanley's Mike Wilson right now, but who knows?
You think Oracle will be?
Yeah, but it's up 4.
Right.
I mean, it's a jinx on Safra. It's a jinx. She's superstitious.
How important is the call on something like Oracle, or not necessarily?
Very, because for Larry Ellison will at one point eviscerate everyone.
Does he get on the conference call? Ellison?
He always has there's a Q&A and suddenly he pipes up.
Okay.
And usually it just says, it's kind of like when he pipes up.
Hey, quick reminder, if you want to email us for bundle codes, email us at staff@meetkevin.com. Again, we'll have an expiration this Friday at June 16th in the evening. So email us before then at staff@meetkevin.com. We'll get you taken care of. So market's obviously doing pretty dang well at the moment. I'd like to see, it looks like you've got Tesla up right now about 1.3%. The Qs for the NASDAQ up about 0.5%. You've got NVIDIA sitting up about 1% at 391. Wow. AMD up another 3%. Google's up 0.76. Apple up about half a percent. So you're going into a pretty green day here. Microsoft up about 0.64. You've got Bill.com down a little more than 2%. Enphase down about 1.59%. So you get a little bit of lagging over here, especially in that solar space. Solar Edge down 1.89%. Generac actually up 3.4% though. So a little bit of a balancing act over there. All right, let's continue on with Jimbo here for a moment.
Today is about the value of Prime. Prime and apparel, Prime and footwear, Prime and the value of the Prime Plus. So
there's no profit in Prime. It's great for the customer, though.
Incredible moment where they're trying so hard to talk about efficiency. And who's the king of efficiency?
Mark Zuckerberg is the king of efficiency.
Do we have a quote on that? Can we just go there?
Would you like to go there?
I did, because it's part of the Magnificent Seven.
I think we can share some of what Zuckerberg had to say. Actually, I'm not sure we can.
Well,
we don't have it yet.
Okay, the reason I wanted to go there is because he's talking about Elon Musk being a person that he respects. And yes. I thought that if we went over the Elon Musk archive of your interview,
yes,
where does he talk about the level of efficiency that Zuckerberg talks about?
Well, he does. We actually had a specific back and forth, Elon and I, about whether the firings that took place at Twitter gave cover to other CEOs to pursue their own plans of efficiency.
Then Zuckerberg watches
because when you fire 75% of the staff, it gets people's attention. I actually think we do have that back and forth with
Musk. What I'm saying is Zuckerberg watched the interview, and then he took action. He watched your interview,
yes,
and then commented.
No, but I think that Zuckerberg may have actually talked to Musk. Take a listen.
Have you heard from any of these CEOs who said thank you for doing that, giving us sort of runway or leeway to at least make some cuts of our own?
I've heard that from a few people, and I've heard that through the grapevine. Yeah, but like I said, if desperate times call for desperate measures, and unfortunately, those were desperate times.
That was Elon, of course, talking about the cuts he had to make at Twitter, given the very precarious financial position the company was in. But I'd ask that question, Jim, because I was hearing it a number of times, which was there are CEOs who quietly have been saying to Musk, you know what, you helped by doing that. You gave me cover to fire a lot fewer people, but nonetheless take on sort of some of this entrenched bureaucracy, so to speak. I think we do have Zuckerberg now. Take a listen.
His actions led me, and I think a lot of other folks in the industry, to think about, hey, are we kind of doing this as much as we should? Like, could we make our companies better by pushing on some of these same principles? My sense is that there were a lot of other people who thought that those were good changes, but who may have been a little shy about doing them.
There you go. Musk leading yet again. And Zuckerberg actually sort of saying that was one of the key reasons why he felt perhaps emboldened to embark on this drive towards efficiency that has resulted sadly, and a lot of jobs being lost, but nonetheless, of course, has been rewarded by shareholders.
I bring it up, and I think it's really important because you and I know each other for a long time.
Yes.
In 2000, a lot of people want to say, well, this is a bubble, okay? In 2002, things happened. One is that the companies ran out of money, okay? And then second, they started laying off people because they ran out of money. This time, they're making fortunes, and they don't need to lay off people, but they want to make even more money. And I think that those who say it's bubblicious, they should watch that interview and listen to your interview. And the one thing you come back with is these are not bubbles. These are nation states.
Well, and even Benioff, for example.
Nation state.
Yeah, Salesforce. I mean, again, it's not just Meta. You can go through many different companies that have had, in the technology area, to your point, very profitable companies, Alphabet, on and on, Amazon.
All right. It's an interesting argument about how much money these companies are making, and it's not wrong. What I'd like to do is take a look at Zuck's email. I don't think I've shared my opinion on it yet. So let's take a look at this for a moment. And I'm going to give some of my revised thoughts on the Apple Pro Vision or Apple Vision Pro headset thingy, majiggy. Okay, stand by for a sec. There we go. Let's provide an update on my thoughts on the Apple Pro Vision headset, as well as analyzing what Mark Zuck had to say about the headset. I am an owner of the Quest headset, mostly my son. He's 7 years old. He loves it. It's great. I've personally found that, and this is just my opinion, I go into, anytime I hear VR, I go into it a little bit with a jaded mentality, just because I personally, and it's just my personal opinion, have found that I could use it for maybe 30 or so minutes, and then you start getting a little kind of maybe dizzy, or you feel that eye strain, right? The hope is that in the future, maybe that won't be the case anymore. Now, I made a sort of a meme of a video where Elon, or rather Apple, was talking about being concerned about myopia in children because children are spending too much time on their screens. And so I made a joke that, so sure enough, Apple comes out with a product to put the screen right in front of your face, which, is obviously extreme because, of course, the idea is that with the Pro Vision headset, you're able to maybe potentially have your focal, your eyes focus on something that's a further distance away because of the augmented reality feature. But then again, if you're just putting screens in virtual reality right in front of your face, maybe that doesn't make that much of a difference. Personally, I have to say, when it comes to memes, though, probably my favorite so far is by far this one shared by Elon Musk, which is on screen right now. You can see it here. It is an image of somebody at breakfast eating waffles, seeing, well, the upper half of a woman, but her face is covered by what appears to be somebody using a drone to target a tank in their Apple Pro Vision headset. But they have in front of them basically everything they are potentially interested in, which is controlling war, the top of this lady and their breakfast. Quite an interesting share. But anyway, so let's talk a little bit about Musk's response and some of my revised thinking around the Apple headset. I want to be very clear. I've initially been negative on the Apple headset, and I still believe this is true because I think initially there will probably be a pretty substantial productivity drop in using the headset. I do not believe that controlling Lightroom or Photoshop or your emails or your day-to-day task or stock trading is going to be as efficient on a vision-based controller device as compared to just your fingers and using a keyboard. Who knows? But let's just say Siri has been around for, more than 13 years. Siri, in case you didn't know, was actually a standalone app that came out, I believe it was in 2008 because the App Store launched in 2008. The phone came out in 2007. I believe Siri was out in about 2008, 2009. I remember being on a date with Lauren and I'm like, oh, look at this cool app. It's called Siri. It's like voice dictation. That was before Apple actually bought the company and built Siri into the iPhone. And Siri hasn't gotten great in the last 15 years, which is kind of crazy to think about that. It's been 15 years and Siri still kind of sucks. So my big concern with the Apple headset is that at first you sell this novelty item and the goal is let's try to figure out how to make it a productivity enhancer. Because if it were a productivity enhancer, I promise every company under the sun is going to buy it for their employees. So for example, for my employees, I buy an iPad Pro with the Magic Case, with the pencil, that you're talking about, somewhere around $2,000 just for that. You throw in a laptop, you're another $1,500. You throw in a desktop, you're another, $1,500, whatever. It adds up. You throw in an Apple Pro Vision headset at $3,500, you could potentially double or at least increase your spend by 50% on starting a new employee. But if the productivity enhancement is so valuable that you're willing to spend that money, then of course I would buy Apple Pro Vision headsets all day long as a business owner. Every single one of my employees will get an Apple headset if it proves to be a productivity enhancer. So the big question for me as to what happens with the Apple Pro Vision headset, as to whether or not it makes a lot of money for Apple, the big question isn't, is it going to function? The big question is it going to enhance productivity more than the iPhone, the iPad, or your laptop and your mouse and your computer, right? So that's the big question. That's the big question for me. Now let's look at Mark Zuckerberg's responses and let's consider what I just said in regards to the productivity requirement we have as a stock investor when it comes to the Apple Pro headset. Now remember, I'm not a tech review channel, okay? I'm a financial advisor. I'm a licensed financial advisor. I'm a real estate broker, which is actually very rare that you have somebody who's both of those. Usually those are totally opposite worlds. I run an ETF. I sell courses on building your wealth and making more income using AI, not as a computer programmer, but as somebody who's an entrepreneur who wants to make you a more productive person. All those courses are linked down below. We have a coupon expiring on Friday as we continue to add value to the courses, and the price will be going up. So what does Mark Zuck say? Apple finally announced their headset. So I want to talk about that for a second. I was really curious to see what they were going to ship. Obviously I haven't seen it yet, so I'll learn more as we get to play with it and see what happens and how people use it. From what I've seen initially, I'd say the good news is there's no kind of magical solutions they have to any of the constraints on laws and physics that our teams haven't already explored and thought of. What's with the grammar, Mark Zuck? There's no kind of solutions? Anyway, they went with a higher resolution display, and between that and all the technology they put in to power it, it costs 7 times more money than our headset, and it now requires so much energy that you need a battery and a wire attached to it to use it. So first of all, I'd just like to break down that this argument that the battery is detached, I actually don't think is a very valid argument to poop on this headset. And trust me, I've said my share of negative things about the headset, but I actually do not think the separate battery is one of them. The reason for that is because when you have a separate battery, you don't have this stupid weight on your head affecting more of, or potentially creating more neck strain because you have this big anchor on your head. That's just my thesis. They made that design trade-off. See, I don't see that as a trade-off, but whatever. And it might make sense for the cases they're going for, fine. But look, I think that their announcement really showcases the difference in values and the vision that our companies bring to this in a way that is really important. We innovate to make sure that our products are as accessible and affordable to everyone as possible. And that is core of what we do. And we have sold tens of millions of Quests. Okay, let's pause there for a moment. So, when we understand that the Quest is affordable, what we should really do is go back to like the Metro PCS days of 2007 and go, hey man, that T-Mobile Razr or Metro PCS Razr, whatever, just became affordable. That's cool, man. It's a cool flip phone with a color screen. You could play Snake in color. Ooh, I used to do that, okay? I used to have the Razr. This was my childhood, okay? You sit in the back of the bus and you're playing on your T-Mobile Razr, you're playing Snake because there was no app store, okay? Like that's the kind of crap 2006 had to deal with. No wonder the dot-com bubble was a bubble because there was no technology. But anyway, you'd play like chess on America Online after you got your mail. But anyway, so chess, man. Anyway, so that technology was a joke, and those phones had become affordable, right? This idea of affordability. Well, when Steve Jobs announced the iPhone, he was laughed at for announcing a phone that didn't have a physical keyboard, that you should use your finger to control the device. And he was laughed at for that. In fact, people at the Apple presentation, if you go back and watch it, they thought it was a joke when he first showed just a glass screen. And back then, the phone cost you $1,000. Now, it was subsidized by like AT&T and the cell carriers, but it was still deemed unaffordable. But that phone went on to be the greatest revolution of really a generation, the smartphone. And like the real smartphone. I'm not talking about the Palm Pilots or whatever, which I used to use to LAN party, which sounds insane that you could LAN party, but I would basically set up my own wireless network because they had like IP blockers in my high school. So I set up my own hotspot using a Palm Pilot back in like 2007 in high school so I could play World of Warcraft. And I couldn't do any PvP, but I could have enough of a good connection to farm. So I'd go collect herbs and rocks. Steve would be happy about that, maybe. But anyway, so this idea of affordability, I think, is actually a pretty weak argument from Mark Zuckerberg, to go back to the point here. Which, by the way, if you notice that my camera is moving around, that's because I set it to this little AI face tracking thing. And it's this really cool webcam that I'm using now. You can check it out by going to metkevin.com/webcam. metkevin.com/webcam, or it's linked down below. Paid promotion. It's an affiliate link, but it's a really great product, and I kind of just have been having fun with it. And it's so good. I finally have a good webcam. I've been pissed off with so many webcams, but anyway. And I will say they say like, oh, you could use your iPhone as a webcam. That thing is so freaking laggy. I don't know. For me, it wasn't good. But then again, I'm tired of like Bluetooth. Anyway, so okay. Okay, so moving on to Zuck. More importantly, our vision for the metaverse and presence is fundamentally social. Okay. Fundamentally social. It's about people interacting in new ways and feeling closer in new ways. Our device is also about being active and doing things. By contrast, every demo they showed was a person sitting on a couch by themselves. So, unfortunately, when somebody goes to an extreme to make an argument, and that extreme is false, it actually discredits them. So unfortunately, this is an example where Mark Zuckerberg actually discredits himself. Apple does not show every example of somebody being on a couch. In fact, they very distinctly show somebody standing up and doing like laundry, for example, or working in the kitchen and cooking, and then kicking a ball with their child in the room. Or what I actually did enjoy was the FaceTime, the augmented FaceTime reality that they showed, where the cameras basically recreate your face and will show your face as an AI-generated face. But when you're actually FaceTiming people, people can see what is roughly your face rather than just some kind of stupid meme emoji or whatever, which is actually the Zuckerberg approach, right? Zuckerberg is taking this very Nintendo Wii-esque approach to creating these memes of yourself rather than just showing yourself in the Apple Vision headset. And I actually think that was really good about the headset is the FaceTime capability. Even though you're not regenerating, like you're not actually showing yourself, the fact that you could see a rough representation of yourself as a character, but it's you rather than a meme. Boy, I thought that was actually very, very impressive and a very good choice by Apple. For example, this is what that looks like. I'll pull that up over here. If you remember, this was the demo they showed. So this is a person wearing the headset. It looks really good. So very, very impressive, given that the person would actually be wearing the headset, but the recipient would be seeing this. That, in my opinion, is much more social than Mark Zuck over here is letting on. Mark Zuck is being disingenuous in this argument here. Every contrast is every demo is somebody sitting on a couch by themselves. That is not true. But anyway, I mean, that could be the vision of future computing, but like it's not the one that I want. There's a real philosophical difference in terms of how we're approaching this. No, there's not. And seeing what they're putting out there and how they're going to compete just made me even more excited, in a lot of ways optimistic, that what we're doing matters and is going to succeed, but it's going to be a fun journey. Honestly, I'm very disappointed in Facebook. And I know that Facebook stock has done very well year to date. You could not have bet against Facebook, stock-wise. But from a fundamental point of view, the money that they're throwing into Reality Labs, I personally think, is good money being thrown after bad. I do not think that their product is innovative. It is a near-focus vision device. It is not augmented reality the way the Apple device is. Honestly, one of the best innovations that I think of the Apple headset is actually the fact that they're going to use this little scrolly wheel that you have on the watch or these headsets to transition from now I'm in VR, now I'm in augmented reality. I think that'll be so cool. Hey, Steve, I see you there. Really, really, really excited about it. I am bearish about I'm bearish about the productivity in the short term. So I want to just stake myself in make a very clear point. I'm bearish about how productive the device is going to be for the first few years. But 10 years from now, that will become a productivity enhancer. I'm probably going to be very, very bullish. So kind of excited about that. Let's see here. Kevin, Meta has been developing that digital copy for their devices too. But see, there's a difference between have been developing and actually use. So I'm curious about that. Now I know Facebook will end up coming out with, and Meta will come out with new devices in the future as well, and we'll see what happens. But I'd like to make simply the argument here, not based on these future device options or whatever, but I think that Mark Zuckerberg's argument is weak. So I'm going to leave it there. Now, from a stock point of view, what matters most going forward? It's productivity. Which device is actually going to enhance productivity the most? That's my opinion. And whichever company wins on productivity, I think will end up winning the most in terms of enhancing value to not only their users, but to their shareholders. So that's my take. So we'll see what happens. Those are my thoughts. Good luck on the market opening today. I've got to jump over to the course member live stream. If you'd like to join me there, make sure you join the courses. You get lifetime access, and we do fundamental analysis almost every single day in those courses, and you get access to all my future video lectures that we release, which is a great feature for all the